What if I told you right now, in Seattle area market, some buyers and investors can purchase brand new home for $850,000 with mortgage rate as low as 3.75% fixed for 7 years or 4.99% fixed for 30 years. That means your monthly payment on your rental home might come surprisingly close to the price what most people already paying for the rent. So here the real question: should you keep waiting, keep renting, invest in the stocks, or use this kind of opportunity to buy real assets while builders' incentives still exist? Today I want to walk you through why this matters, why math may surprise you, and why in some cases buying real estate right now makes more financial sense than most people realized. Hi, I'm Oleg Dukhnevich, real estate broker with Winner in Bellevue Comments. I help people buy and sell homes, but also I spend a lot of time on bigger wealth building question. When real estate does make more sense than waiting, renting, or simply putting money in a stock market. And right now, because of special financing being offered by some builders, this is one of the moments that deserve closer look. Because when you can buy a new construction home for $850,000 with only 20% down payment, and this payment start looking competitive with local rents, it stops to be just housing conversation. It becomes investing conversation. Let's start with stocks. There are good reasons why people invest in the stock market. It is simple to start, it is very liquid, you can diversify quickly, you don't need to manage tenants, repairs, or property issues, and historically, over a long period of time, the stock market has delivered strong returns, and that matters. If somebody wants a passive income and doesn't want responsibility comes with real estate, stocks may be a good fit. You can invest consistently, you can keep your costs low, and let time do the work. This is real advantage. But real estate has a few powerful advantages that stock market doesn't offer in some way. First is leverage. This is biggest one. With stocks, if you invest $100,000, $100,000 is what goes to work. With real estate, $100,000 becomes down payment for much larger asset. For example, with 20% down payment, you can control $500,000 property. It's much higher assets and depends on the program. That means appreciation happens on the full value of the property, not only on the cash you put in. Alright, second advantage is tenants help to pay mortgage. With rental property, the tenant may cover large portion of your monthly mortgage payment. That means parts of your investment supported by someone else's rent, while you continue to build equity over the time. And third advantage, loan pay down, build wealth quietly. This is a powerful form of forced saving. Even if appreciation is modest, the loan pay down alone helps to increase your equity. Number 4. Tax advantages. Real estate may offer write-offs and tax benefits many investors find attractive. Depending on your situation, that may include mortgage interest, property expenses, depreciations, and other deductions. Of course, if you are an investor, please confirm details with your CPA. And number 5 benefit, that's a hard assets you can see and control. The property is a tangible asset. You can improve it, you can change strategy, you can raise rent over the time, you can refinance later, and you can own for a long term. that level of comfort one of the reasons why many investors prefer real estate. And now let's cover some weaknesses of real estate. And let's be fair, real estate is not perfect. It has downsides too. It's less liquid than stocks. It requires more capital upfront. It comes with maintenance, vacancies, repair and management. It is local. It's not instantly diversified. And bad purchase can hurt you if you overpay or choose a wrong area. And this is why the real estate is not automatically better. The key is buying right property with the right numbers in the right market with the right financing. This is where strategy matters. Why today may be an opportunity. This is where conversation becomes very interesting. A lot of people waiting for rates to drop. But when rates drops, competition often increases. Price may rise, and investors who's waiting may find out that the better time never actually become a cheaper time. But right now, in several area market, some builders are offering financing that changes that mess in very real way. For example, on a new construction home around $850,000, buyers may secure something like 3.75% fixed for 7 years or 4.99% fixed for 30 years. This is a major adventure comparable to the open market, typical investment loan with a much higher rate. And this is why opportunities matters. With 20% down payment, the monthly payment may land much closer to local rental rates than many people expect. So instead of paying rent somewhere else, waiting on the sidelines, hope market will change, buyers may be able to control a brand new asset, lock in a better financing, let tenant help cover the payment and start building equity now. That is not just a home purchase, that is a strategy. And now let's compare stocks versus real estate. Here's the simplest way to look at it. Stocks may be better if you are looking for a fast liquidity, you want very passive approach, you want instant diversification, and you don't want to deal with property ownership. And real estate may be better if you want leverage, you want tenant to help to support your investment, you want one of the biggest tax advantages, you want a long-term wealth through appreciation and loan pay down, and finally, if you want more control over your assets. The biggest mistakes in not choosing stocks versus real estate. The biggest mistakes is doing nothing and waiting for better conditions. Perfect conditions almost never arrived. Wealth is often built by making good decisions during imperfect moments. Imagine investor has enough cash for 20% down payment to buy $850,000 new construction home. They can put that capital into stocks and hope for long-term growth, and that may be still a good option depending on their goals. But if they invest to buy a property with a builder offer rate 3.75% for 7 years or 4.99% for 30 years, now they're using the same capital in a very different way. Now they may get control of much larger asset, a payment that may be surprisingly competitive with the local rentals, monthly principal reduction, positive appreciation, and potential tax advantages. This is exactly why some buyers should not automatically wait for a lower rate, because by the time standard rate improve, builder incentives may be gone, prices may move higher, and competition may become much stronger. So, which one is better, stocks or real estate? I'd like to see your comments below. The honest answer is it depending on your goals, your risk tolerance, your timeline, and how involved you want to be. But if you are an investor with capital and you want to explore whether the property in today's market makes more sense than continuing to wait, that is a conversation worth having, especially when special financing can bring monthly mortgage payments much more closer to the local rental market. If you are thinking about investing and want help analyzing where the specific market makes more sense as a rental or the long-term wealth building opportunities, reach out to me. I'll be happy to help you run the numbers, compare the strategies, and see if buying now put you in a stronger position later. I'm Oleg Dukhnevich, and I'll see you in next video.